Hello everyone and welcome to Fundamental Auditing Chapter 10. Chapter 10 is about audit sampling. So an audit sample is an application of an audit procedure to less than 100% of the items in the population. So as auditors, we don't have to audit 100% of every single transaction, every single journal, like every single entry into the general ledger accounts. We would just take a sample of the population to test. But this chapter talks about how do we figure out what type of sample to choose, what happens if we find errors. It's going to go through audit sampling and how we determine everything around sampling. Okay? So we don't have to audit 100% of every single transaction. This is related to the audit risk, right? How much risk are we willing to accept that we will issue a wrong opinion on the financial statements? So then we would also look at detection risk. The lower the detection risk, the more work we have to do, the more samples we have to obtain. So just some terms before we get into it. So an audit procedure is the technique that you're going to use, such as computation, observation, confirmation, inquiry, inspection, analysis. We talked about this in Chapter 8. It's the procedures you're going to use to get your evidence that something is not materially misstated. Account balance is like the inventory account balance or cash account balance, revenue account balance. Classes of transactions are a group of transactions that have common characteristics, so cash receipts or cash payments. And then the population is like the total, like total transactions that happen in an account balance. Okay. Population unit is the elements of the population. Sampling unit is the amount that has been sampled in a population. And then a sample is a set of sampling units. So like I was saying, risk is tied to how many samples that you're going to obtain, right? So the lower you want your audit risk, depending on what your inherent risk and control risk is, you're going to figure out your detection risk, and that's going to help you decide how many samples to do. Also, materiality is related to sampling because you're going to look at, well, how big is your materiality, and sample things that are 100% sample things that are above a materiality. You want to obviously test those. Maybe you're taking the whole amount depending on how many there are, or maybe you're taking a sample of it. And the things lower than materiality, you're taking less of the sample of, or maybe not even sampling it at all. Right, so we have to look at the nature, timing, and extent of our audit procedures. So the nature is what the technique's going to be used. The timing is at what point of audit the procedures are going to be performed. So we talked about the fact that some procedures can be performed before year end, so especially internal control procedures. You could do that before year end, but there's some substantive procedures that have to happen after year end if you're confirming the year end accounting amounts. Okay? And then the amount of work that you're going to do on the procedures. So sampling is part of the extent of the audit procedures. And there's two types of like audit programs where we're going to do sampling and do audit procedures on. So it's the internal controls, right? So we're going to select a sample of what to audit when you're looking at the internal controls and doing internal control testing. And then when we're doing substantive testing, looking at the balances, we would sample like an asset balance or liability balance, but not every single transaction in there. Okay, so like I said, sampling is looking for a part of the population in order to reach a conclusion of the entire population. So sampling is not when you're auditing 100% of the balances. So maybe there's only a few balances in the assets accounts or in the revenue. Maybe they have only like 3 or 4 big clients a year. Then you could probably audit everything, because if you're just auditing like 3 or 4 of the accounts, customer accounts for the revenue items, then you can get away with doing 100%, but there's some other revenue item, like another company that has so many revenue items throughout the year, it wouldn't make sense to audit 100%. So you don't do sampling on analytical procedures or walking through, like doing a walkthrough of transactions to understand inquiries, scanning, or observations. Those aren't something you get a sample on. It's when you're like doing inspections mostly. So you're not going to inspect every single invoice. You're going to sample which ones to get. All right. And sorry, the reason why we don't do 100% testing is because the cost, you have to look at the cost versus benefit of doing it, and how much of a risk you're willing to take. So what audit sampling does, it uses the laws of probability for selecting and evaluating a sample. And then the purpose of that is to reach a conclusion about the total population. So there's two types of methods. So there's statistical sampling and non-statistical sampling. So statistical sampling is a sample that's selected at random, and there are statistical calculations used to determine what you're going to sample, and each item of the population has an equal likelihood of being sampled. And you have to do a random sample. Okay, so here you basically you would audit when you're looking at like what sample to choose. You would select, for statistical sampling, you would choose a sample at random. Each population item does have an equal likelihood of being selected. So for example, here, if there's 100 records and you're doing statistical sampling, you would what you could do is you could pick every 10th. So you can pick every 10th account or every 10th invoice. So 10, 20, 30, 40, 50, and so on. So therefore, each population item has an equal likelihood of being selected. And then there's non-statistical sampling, or what we call it is judgment sampling. Here, the sample selection could be at random or not, but here you're considering things like your judgment. So if you know that there's some accounts that are higher than others, you want to pick those high accounts. So in that case, you're not picking things at random. You're not giving each part of the population a chance to be selected. You're using your judgment and saying, okay, I'm going to select these items because they're higher numbers, or I'm going to select these items because there's more of a risk that these items could contain misstatements. There's also something called sampling risk, and we have to take this into consideration when we are sampling. So sampling risk is the probability that an auditor's conclusion is different. So the auditor's conclusion based on the sample that they've chosen might be different from the entire population. So if they choose a sample and do their work on a sample and they find 1% of errors in that sample, they can kind of apply that to the entire population. Say there's probably 1% of errors in the entire population. So sampling risk is that they were wrong. The sample that they chose was different from what the actual entire population chose. So there's two types of sampling risks. There's efficiency risk, where the risk that the auditor will conclude that the population is actually worse than it really is. And then there's effectiveness risk, where there's a risk that the auditor will conclude that the population is actually better than it really is. Usually auditors are more concerned of saying that something is better than it actually is than saying that something is worse than it actually is, because they're going to do more work into investigating if the error is above materiality. They'll do more work to investigate. But if they think that they're concluding the population is better than it really is, then they can potentially issue a wrong opinion. Both of these types of risk can be controlled by auditing the amount of large samples, right? The more samples you audit, the less of a sampling risk you're going to have. Non-sampling risk. So basically, this is like any risk other than sampling risk. It's a possibility of making a wrong decision. controlled by like policies and procedures. So the auditor can make a wrong decision because they made maybe an improper assessment of inherent risk or control risk, or they didn't apply the audit procedures carefully. So maybe they picked the right amount of samples, but they didn't do their audit procedures properly. Okay? Or made errors based on projections and made a wrong conclusion about the population. All right, so what we'll do now is I'll show you the steps, the sampling steps for if you're testing internal controls of the company. And then I'll show you the steps if you're doing substantive procedures for the company. So the two different types of audit procedures you're doing, either on test of controls, on internal controls, or you're doing it on the year-end balances, which is substantive testing. So for test of controls, there's 7 steps you have to go through. So we'll go through each one individually. So the first one is figure out the audit objectives. So when we looked at chapter 9, we looked at the types of control objectives that you want to meet with the types of audit procedures that you do. So first you have to figure out what control objectives am I going to satisfy doing these tests of controls. Okay, so you'll do that first. Then you're going to define the deviation conditions. So basically, you're going to determine what are you looking out for that's going to be an error. So deviation, same thing as an error. So before you do the test, you want to say, okay, what am I looking for? What type of errors am I looking for? So what is defined as an error and what is not? Okay, so you define this prior to testing so the auditors know when they're doing the test when you can see an error, right? So you have to like figure out what are the errors I'm looking for. And to do that, you need to be able to understand the internal controls. So if one of the controls is that the supervisor approves all transactions that are posted into the system, what you're looking for when you're doing the test is approvals. So a deviation from that internal control procedure is not having a supervisor like timestamp and signature. Okay, so that would be the error you're looking for. Number 3, define the population. So figure out what population are you going to select the sample from, right? Figure out like the timing of the tests, what dates you're going to use, the list of transactions that you're going to use, right? So just figure out the total population that you're going to obtain the sample from. Number 4 is figuring out what the sample size is going to be. So for example, if you have 100 accounts, what does your, like how much of a sample are you going to choose out of those 100? Okay? So there's a bunch of factors that influence the sample size. So sampling risk, right? Risk that what you sample is not reflective of the entire population. So you have to keep that into mind. A tolerable deviation rate is something that you have to keep in mind as well when figuring out sample size. This is the tolerable deviation rate is basically the deviations that can exist without causing a material misstatement. So how much of a deviation or of an error is tolerable where it won't cause a material misstatement. Looking at like the population size, so if you're auditing 100 counts versus 10,000 counts, you're going to have a different type of sample size for that. So there is like a formula that is used when figuring out the sample size, and that is discussed in Appendix 10A and 10B. So in the appendices, it goes through how you determine the sample size, and it is a bit of a complex calculation. So I can show you an example of this. So to figure out the sample size, it's going to be n, which is your sample size, equals r, which is your confidence level factor, and divided by p, which is your materiality, or it's your percentage of your materiality. Okay, so in this case, what a confidence level factor is, it's based on your effectiveness risk. So the effectiveness risk is that you're going to provide a conclusion that is actually better than what is actually happening. Okay, so If your effectiveness risk is 5%, for example, then your confidence factor is going to be 1 minus the 5%. Okay, so let me just write that down. So R is a confidence level factor, and I'll explain to you how you get that. That you have to find using the tables, because it's a complicated calculation. But basically, your confidence level factor is your effectiveness risk, which is something that you determine. Sorry, it's 1 minus. So 1 minus your effectiveness risk. So if you know the effectiveness risk, 1 minus the effectiveness risk gives you the confidence level factor. Okay, so for example, let's say that your effectiveness risk is 5%. Let's say your materiality, so this is going to be in terms of a percentage. So basically, like, you could use like your tolerable deviation rate. So let's say in this case, it's 6%, or 0. You could put it in decimals, it'll be easier to do the calculation. Okay. So if we go into the tables in Appendix B, you'll find the confidence level factors to find out what your sample size. Okay, so let me just show you. So if you go into Appendix 10, go to page around page 60. Actually, it starts a little bit earlier than page 60. So page 59. So these tables will show you the R value. So what we need is R, which is our confidence level factor, for our effectiveness risks. So for effectiveness risk is 5. So these are 50, 45. So let's go find 5%. Okay, so this is 18%, 17%. We want to find 5%. So here our effectiveness, our effectiveness risk is 5%, which makes our confidence level 1 minus 5%, which makes it 95%. So we'd have to look at this column. Sorry, we want to look at this column to figure out how much of a sample size to choose. For the amount of errors, we're going to pick 0. So when you're initially picking your sample size, you're going to use the k equals 0. So the amount of errors, we're going to assume that there are 0 when we first want to pick our sample size, because we don't know how many errors there are. So that means if your number of errors is 0, your R is 3. Okay? So using the confidence level of 95%, go to your R is 3. Okay, so let's go back into here. Okay, so then R, oops. So if it's N equals R divided by P, your R is 3, your P is 0.06, which means you get 50 here. So your sample size is going to be 50. Okay, so you do have to go into the tables to figure this out. So the tables have determined what your confidence level factors are. You use it to figure out what your R is. You would have to go into the table. In some like audit, like whatever auditing system that you use to do your audit, they could automatically do this calculation for you. So you just put in the information and then they'll do the calculation for you and say how much samples do you need. So usually they'll go, auditors will like input the information and it would output a calculation of what your sample size is going to be. All right. So after you figure out what your sample size is going to be, then you select your sample. So the audit sample has to be selected from the population, which you've already selected. It should be representative of the population. You should try to obtain like selecting random samples. So each unit in the population has an equal chance of being selected. But depending on if you want to use statistical or non-statistical, you might look at like the higher numbers. Maybe you want to make sure that you get some of the higher numbers in there. So you're going to pick that. Or for statistical sampling, maybe you're using a random number generator, right? So a random number generator comes out and just pops out numbers, and you're going to select those. So if it's, if it says 2, 7, 24, you're going to select sample number 2 out of the population, number 7 out of the population, right? So you can do a random number generator to make sure that your sample is random, or you can pick and choose, which would be non-statistical. And then number 6, now you're actually performing the control tests. Okay, so that's when you're doing your inspection, recalculation, anything that you need to do to actually perform the test. And then the last thing you're doing is you're evaluating the evidence. So whatever evidence you get, there's 2 risks when you're looking at the evidence. One is that maybe you assessed control risk too low. So you concluded that the control risk works better than it actually does. Or you've assessed the control risk too high, so you concluded the control doesn't actually work well enough when it actually does. So assessing control risk too low means that you've threatened the effectiveness of the audit, right? This is pretty bad if you're saying that control risk is good, but it's not. So you probably have to revise your substantive procedures, like how many samples you choose for that, because your detection risk is now going to change. If you've assessed control risk too high, that means you probably are going to be doing like too many audit procedures. So that's threatens the efficiency of the audit, but that's not as big of a deal as assessing it too low. What you're going to do when you evaluate the evidence is you're going to calculate the sample deviation rate. So you're going to determine the rate of errors in the sample compared to the total sample. So here, for example, if you sampled like 60, if you did looked at 60 samples and you found 1 error in the 60 samples, like if you're looking at whether like the shipping document was does every anything that got shipped out have a shipping document? If 1 did not have a shipping document out of 60 samples that you chose, then your sample deviation rate would be 1.7%. Okay, so that would be like the error rate. So you can kind of look at this and apply it to the total population. So saying if you have 1 error in 60, then in the total population, what percentage of errors do you have? And then you would compare this to your tolerable deviation rate to see how many errors can be tolerated depending on materiality, and then see if it's higher or lower than that 1.7%. Okay. And then you would follow up on any deviations that you did uncover. So any errors that you did find, you would have to follow up on them and then draw a final conclusion. So if control risk actually appears high because you found all these deviations, then you would have to do additional substantive procedures or do more control procedures to see if there actually is more errors. All right, now when doing substantive testing, so auditing the actual account balances, when you're looking at how much to do, you're looking at detection risk, right? Detection risk, the lower detection risk, the more samples you have to obtain. Detection risk is actually a combination of 2 different risks. One's called analytical procedures risk, which is the probability that analytical procedures will fail to detect material errors. So analytical procedures are, comparing last year's numbers to current year numbers. So the lower, the more reliance on analytical procedures. So if there isn't really much of a risk that analytical procedures will fail to detect, like if analytical procedures will detect errors, then the lower that risk can be. Okay? And then the second part is the risk of incorrect acceptance. So this is the probability that test of detail procedures will fail to detect material errors. So it is the risk that the procedures that you do will fail to detect material errors. So in order to, if this is low, you'd have to do more work. Okay, so the lower the risk of incorrect acceptance, the more work you need to do, the more samples you need to obtain to make sure that your procedures will not fail to detect material misstatements. So if we expand our risk model, so remember our risk model was, we did it as DR equals AR divided by IR times CR, which I showed you back in chapter 6. Now, if we split detection risk in two, we're solving for the risk of incorrect acceptance, which can be, it's the only risk that can be controlled by the auditor based on how much work they're going to do. So we're going to solve the risk of incorrect acceptance. So that is going to be your AR divided by your audit risk divided by your inherent risk times your control risk times your analytical procedures risk. So our risk of incorrect acceptance is going to help us determine how many procedures we have to do or how much samples we have to do. So for example, if sticking with our AR, if our AR is going to be 0.05, which is usually what we use, and let's say our inherent risk is high at 1, our control risk is medium at 0.5, and we have a risk that our audit procedures aren't going to find anything. Sorry, our analytical procedures aren't going to find anything. So we're going to make that high as well. And if we do this, we're going to get 0.1 as our RIA, which is pretty low, which means we have to do more work. If we kind of change this around and we think there's really good controls in place, that means we can lower the amount of substantive procedures that we do. So if there's really good controls in place and we say that control risk is low, then our total would actually be 0.25 in this case. So we could do less substantive procedures because our control risk is low, right? The higher the control risk, the more substantive procedures we have to do. So the lower the risk of incorrect acceptance, the more procedures, the more samples we have to do, more testing we have to do. So the risk of incorrect acceptance is basically your effectiveness risk. So you're accepting a balance as correct when it's actually has material misstatements, or the risk of incorrect rejection, saying that a balance is materially misstated or not. Okay? So risk of incorrect acceptance is more important of those two risks because it could lead to providing a wrong opinion, saying that everything is good when it's actually not. Okay, so these are the steps when you're doing substantive procedures or test of details, looking at the actual account balances, not the internal controls. Okay, so first you have to figure out the audit objectives. So you want to look at the assertions. You want to decide whether the client's assertions are correct. So that look at what assertions you're going to be testing. Then you're defining the population. So you're looking at individual items that exceed materiality, right? Those ones you want to look at for sure. And then for the remaining population, so like the individual significant items that exceed materiality, you want to kind of put those in another bucket than everything else that's lower than materiality, because you're going to pick a higher sample for stuff that is material. Then you're going to choose an audit sampling method, so either statistical sampling or judgmental sampling, whichever one kind of works. So maybe things that are above materiality, you want to do judgmental sampling to make sure you get the highest numbers, and then maybe the ones below materiality, you can just randomly select those. Determine the sample size. Sample size is going to be based on your risk of incorrect acceptance. The lower the risk of incorrect acceptance, the higher your sample size has to be. What the materiality amount is, what the expected dollar misstatement in the population is, what's the total size of the population. All these things are going to affect what sample size you choose. And number 5, select your sample. Okay, so you actually go out and select the sample that you're going to test, and then perform the substantive procedures. So perform whatever substantive procedures you're doing, like inspection, recalculation, confirmations, all of that. And then you're going to evaluate the evidence. Okay, so you're going to determine the amount of misstatement in your sample, and then you're going to compare it to like the total population to find out what the projected likely misstatement is. So there is like a ratio method that you can use to determine what is probably the total error in the population based on the sample that I chose. So based on the sample that you chose, let's say that you found a $900, like in total, based on the sample you chose, you found $900 of errors. Divide that by the total sample you chose. So let's say out of 90 things you sampled, the total amount of errors you found was $900. We're going to multiply this by the total population. Okay, so times that by, let's say there was 1,500 like transactions. So there's 1,500 transactions altogether. You only sampled 90 of them, and out of the 90 that you sampled, you found a $900 misstatement. Okay, so you found total errors of $900 in the 90 transactions you sampled. So therefore, the likely misstatement in the total population is 15,000. So this is kind of an estimate that we do based on our sample. So out of 1,500 transactions, you sampled 90 of them, you found errors of $900. So to project that over the total population, we're going to assume that the total population, out of these 1,500 samples, there's a 15,000 misstatement or error. Then what you would do is compare this to materiality, figure out if materiality is 200,000, for example, then this isn't really a big deal, this 15,000. But if materiality is 10,000, then this is a big deal, and you'd have to investigate further. You might have to do more, right? You might have to look at more of these, more than 90. So maybe after doing this and finding errors, usually after you find errors, you want to take more samples and test more samples to see if this error, was it just reflective of these 90, or is there a lot more errors in here? Now you're going to consider your sampling risks. You're going to follow up on any differences, any simple mistakes. Maybe there was a management of override of controls or something. So maybe there was like a big picture kind of error that was happening that could be fixed. Compare your known misstatements and likely misstatements to materiality, right? Figure out if it's material or not. All right, so that's the end of chapter 10. Thank you for listening, and take care.